Can you start off from the very beginning by helping everyone better understand why you think we just had a 55% correction in Bitcoin price from the recent highs?
So I think there are a bunch of different reasons, but I think one of the largest reasons and one of the most underreported reasons was the fact that Grayscale's premium over NAV for the Grayscale Bitcoin Trust went away, turned into a discount. And so if you look at that fund in the second half of 2020, that was the largest buyer of Bitcoin. They were a massive buyer, bigger than MicroStrategy, bigger than any other buyer. The sheer amount of coins they sucked up, and part of that was natural demand. People want Bitcoin exposure, so they buy it in their brokerage account through GBTC. It's an imperfect vehicle, but they relied on that. But two, a lot of that was a neutral arbitrage trade. So someone could, accredited investors could buy into the fund at NAV, which basically took liquid Bitcoin, converted them into that fund, made them illiquid Bitcoin. So you had basically off exchanges into their cold storage, and then they would go and short Bitcoin elsewhere. And then after 6 months, when that lockup period ended, they could sell their GBT shares for the market price, which was generally trading at a premium over their NAV, and they bought in at NAV. And so regardless of what Bitcoin's price did, as long as there were no tail risks of like counterparty issues or something, they would end their Bitcoin short. They would sell their GBTC and they would extract that premium, and it was essentially a risk-free trade. And they could do that every 6 months. They could take that capital and do it. And whenever they'd finish the trade, even though their positions are off, those Bitcoin are now permanently in Grayscale's Bitcoin Trust, because that's not a redeemable fund. So other than potentially selling some Bitcoin in order to pay the expenses, Bitcoin never really leave. It's kind of a Hotel California of Bitcoin, and so that was a really big contributor to Bitcoin's price going up. And when we had some increased competition at Grayscale. So we had Canada's Bitcoin ETF. We just have generally more ways to access it. So there's a Skybridge fund, right? So there's institutional, basically custodians. More people are able to just use things like Coinbase or use other major exchanges, right? So we've seen their numbers go up, and so there's basically fewer people that really need to rely on say GBTC trading at a premium over NAV and 2% fee or whatever it is last I checked. And so basically that with that discount gone, that neutral arbitrage trade can't happen. And so that the biggest buyer just switched off completely. It hasn't been buying Bitcoin. And so if you look at, say, when they're buying when flat, we've had some pretty significant consolidation of the Bitcoin price. And then when you get things like Elon Musk backtracking on his views on Bitcoin being ESG, or some of these other things like the Chinese hash rate migration, which can cause potentially forced selling or disruptions. Any of these other things can then come and impact it. But I think part of the underlying thing was essentially that just one of the big sources of demand dried up, and therefore the market had to rebalance itself.
Yeah, I mean, now GBTC is negative, right? And so
Yes.
it's actually gone the other way, and that trade dissipated. And as you said, that's how a lot of the yield that was being offered in the markets was being offered. How much do you think the leverage played a role in that?
Oh yeah, definitely. I think that's once those underlying fundamental factors basically just triggered less demand. When you started to have prices going down, definitely those liquidations, those big leverage positions, were another big factor, along with Tesla, along with these other kind of headline news. And so they exacerbated the moves. And then therefore, if someone was, say, a momentum investor and they're watching a negative price action, they might get out, or they might not buy when they otherwise might have bought. And so that triggers everything until you have people come in, kind of the buyers of last resort, and say, no, I'm fundamentally long-term interested in this network. I think, say, 30,000 is a great price. And so they come in and kind of try to hold a floor. And so lately in the past, few weeks, it's been kind of testing this floor area, and we'll see how well it holds. But yeah, leverage was certainly one of the big factors as well.
I'm curious, you're talking about GBTC, and you sort of touched on the fact it was the only vehicle for a while, right? If you wanted to invest in your IRA, you needed to buy GBTC. If an institution wanted to gain access, maybe they weren't allowed to buy the underlying asset, but they could buy GBTC. Does the fact that GBTC, that Grayscale stopped buying, and that we've seen this price action, do you think that's an indication that perhaps institutions were less excited or are now more hesitant than we believed them to be on the run up?
I think it could be, but I think I think the bigger story is that just the fund has more competition now. And so if anyone's familiar with, say, equity closed-end funds, they often do trade at a discount to NAV. That's basically, the market's way of kind of, factoring out the expense ratio of the fund, which tends to be higher than, say, passive ETFs, for example. And so if a closed-end fund has a 1% fee, it might trade at a 10% discount to NAV, and so you're basically factoring out 10 years worth of the management's fees. That's pretty common practice in the space, and so it's actually pretty uncommon for these funds to trade at a premium to NAV.
Right.
And so, but Grayscale was, because it was such a unique product. It had such alpha to it, and so it was the only game in town for a while. And so actually, kind of the natural state is to have roughly zero or a slightly negative discount to NAV. Now, I think when it reaches as low as like almost 20%, I think that's excessive. That's pretty uncommon for closed-end funds to do. So there's still kind of an arbitrage trade where if it ever gets really low, it tends to probably be a trade where you want to maybe go long that fund, and then if you're trying to make it neutral, then you can short Bitcoin. And so until that kind of that compresses a little bit. But overall, I think that the Grayscale Bitcoin Trust going into negative, under NAV isn't necessarily tied to institutional interest. You can have that go negative while there's still interest in other products. For most people should not be professional traders, whether it's crypto or whether it's traditional assets like stocks and bonds. And so generally the best approach is dollar cost averaging over time. Now, the difference between something like an S&P 500 and Bitcoin is that Bitcoin's a single asset. You're betting on the adoption of this specific network. And so, for example, I'm generally not one of the people that argues that people should put 100% of their net worth in Bitcoin or other cryptos. But as a slice, maybe owning their own home, maybe having an equity portfolio, maybe having some commodity investments, whatever they are knowledgeable in or bullish on, I think that dollar cost averaging into something like Bitcoin, in addition to those other slices, can be an important part of, say, a long-term strategy, as long as they're continuing, to be bullish on that network. I would say that, for Bitcoin to be successful in the long run, one of the things it has to do is have a pretty persistent fee market, right? So as the block subsidies come down in the next couple halvings, Bitcoin will be increasingly reliant on generating enough fees to kind of, reliably have, some persistent, there's no kind of exact model for how much of a market cap that should be spent on security, but it should be, notable. And so in order for Bitcoin to kind of persistently fill those blocks, you'd probably want it to be an over $1 trillion asset by the time those next couple halvings occur. And so, Bitcoin doesn't have to reach 10 trillion or 100 trillion to be successful, but it does have to reach a certain scale that the blocks are persistently full, that there's a lot of on-chain demand, and that those fees are kind of high enough to ensure security for the network. And so in that sense, Bitcoin adoption by larger entities helps secure the protocol over time, helps keep, raise the success of that asset. Potentially if it reaches more people, if there's kind of firms that are kind of rebalancing, right? So say they have like a 5% Bitcoin position and they're rebalancing, that could potentially reduce volatility. And so I think that those two worlds can still benefit from each other, even if they could have entirely different purposes of using it. And so obviously there are some investors that are really focused on number go up, and so they want institutional adoption, and that's kind of their biggest goal. Whereas other people, like the person I spoke with, Elizabeth Stark, who the whole purpose is to build out the network, build out the Lightning layer, make it more accessible for people in emerging markets. For them, for the most part, it doesn't really matter what the price does, especially because, they might or may not be holding actual Bitcoin. They might be using the monetary network portion without even holding the underlying asset. If they do hold the asset, obviously it would benefit from them if they go up due to, even if it's because corporations are buying it. But I think, there's kind of those two separate. There's Bitcoin, the asset, there's Bitcoin, the monetary network. And, at least, at the bare minimum, corporations buying into it doesn't really hurt the little guy. It either benefits them or it's irrelevant.